Imagine waking up to find you're drowning in debt, with no savings and no plan for the future. Your cell phone is blowing up with calls from debt collectors, and your bank account has exactly $3.57 in it. Scary, right? Well, I'm not here to scare you. I'm here to tell you that it doesn't have to be this way. Welcome to Tectonic Finsight. In this video, we're diving into the world of personal finance to show you how to avoid the debt trap and take control of your money. Stick around to learn the essentials of personal finance and start building a brighter financial future today. First up, budgeting. Think of it as a GPS for your money. It tells you where every dollar is going and makes sure you reach your financial destination. A well-planned budget is the key to financial freedom. One of the simplest and most effective budgeting methods is the 50-30-20 rule. Allocate 50% of your after-tax income to needs, 30% to wants, and 20% to savings and debt repayment. Needs are your non-negotiables. Things like rent, groceries, utilities, and transportation. Wants cover your discretionary spending, dining out, entertainment, travel. Savings and debt repayment include building your emergency fund, saving for retirement, or paying down debt. By consistently following this rule, you'll cover essential expenses, enjoy life's luxuries, and still make progress towards your financial goals. Budgeting might sound boring, but it's the secret to living within your means and avoiding the dreaded debt spiral. Next, we're tackling saving. Saving is like eating your veggies. Everyone knows it's good for you, but it's not always the most exciting thing in the world. One of the most important reasons to save is to build an emergency fund. This is your financial safety net, your backup plan for when life throws you a curveball. Ideally, your emergency fund should cover 3 to 6 months of living expenses. Having a well-stocked emergency fund can mean the difference between weathering life's storms comfortably or going into debt to cover those unexpected expenses. My favorite strategy is to automate your savings. Set up a recurring transfer from your checking account to a high-yield savings account every time you get paid. Remember, saving isn't about depriving yourself, it's about prioritizing your financial well-being. Third, we're diving into the exciting world of investing. Investing is a powerful tool that can help you grow your wealth over time. It's not just for the wealthy or the financial experts, anyone can start investing with the right knowledge and resources. Investing is how you make your money work for you. Instead of letting your savings sit idle in a bank account, you can put that money into various investment vehicles that have the potential to grow. It's about putting your money to work in assets that have the potential to increase in value over time, like stocks, bonds, or real estate. Each of these investment options comes with its own set of risks and rewards. One of the easiest and most effective ways to start investing is with low-cost index funds. These funds are designed to track the performance of a specific market index, making them a great option for beginners. An index fund is like a basket of stocks that tracks a specific market index, like the S&P 500. This means you get a little piece of many different companies, spreading out your risk. When you invest in an index fund, you're essentially buying a small piece of all the companies in that index. This diversification helps to mitigate the risk of any single company's poor performance affecting your overall investment. Index funds offer instant diversification, reducing your overall risk. By spreading your investment across many companies, you're less likely to experience significant losses if one company underperforms. By investing in an index fund, you're not putting all your money into a single stock or industry. This strategy helps to protect your investment from market volatility. And here's a fun fact. Let's say you invest $200 a month in a low-cost index fund starting at age 25. Thanks to the power of compounding, your money can grow significantly over time. By the time you retire at age 65, you could have over $500,000. This is the magic of long-term investing and the power of starting early. So why wait? Start your investment journey today and watch your wealth grow. Chapter 4. Debt Management. Lighten the load. Debt isn't always a bad thing. In fact, it can be a useful tool when managed properly. Sometimes it's necessary to achieve certain financial goals like buying a house or investing in your education. These types of debt can be considered good debt because they often come with lower interest rates and can lead to long-term financial growth. But high-interest debt, like credit card debt, can be a major financial burden. It can quickly spiral out of control if not managed properly, leading to stress and financial instability. Think of debt like a heavy backpack. The more debt you carry, the harder it is to move forward and achieve your financial goals. Just like a heavy load can slow you down on a hike, high levels of debt can impede your financial progress. One effective strategy is the debt snowball method. This method can help you systematically reduce your debt and regain control of your finances. This method focuses on paying off your smallest debts first, regardless of interest rates. By eliminating smaller debts, you can gain a sense of accomplishment and build momentum. The idea is to build momentum and stay motivated by seeing quick wins. Each small victory can boost your confidence and keep you committed to your debt repayment plan. For example, let's say Sarah has a $2,000 balance on a credit card and a $10,000 student loan. By focusing on the smaller debt first, she can quickly eliminate it and feel a sense of progress. Using the debt snowball method, Sarah would focus on paying off the credit card debt first. This approach allows her to see immediate results, which can be incredibly motivating. Once the credit card debt is paid off, Sarah will feel a sense of accomplishment and have more money freed up to tackle her student loan. This newfound financial freedom can provide her with the motivation and resources needed to continue her journey towards being debt-free. Chapter 5. Protection, your financial shield. Let's talk about safeguarding your finances with insurance and planning. One of the most important types of insurance to have is health insurance. Medical expenses can be incredibly expensive, even for minor incidents. Health insurance helps mitigate those costs, ensuring you have access to affordable healthcare when you need it most. If you have dependents, life insurance is another crucial form of protection. Life insurance provides a financial safety net for your loved ones in the event of your death. And while it's not the most pleasant topic to think about, having a will is another essential aspect of financial protection. Chapter 6. Tax Management. Plugging the leaks. Understanding your tax obligations and implementing legitimate strategies to minimize your tax liability is crucial for maximizing your financial well-being. The first step to effective tax management is understanding your tax bracket. Your tax bracket determines the percentage of your income that goes towards federal income taxes. Next, learn to maximize tax-advantaged accounts. Accounts like 401(k)s, IRAs, and HSAs offer tax benefits that can significantly reduce your tax burden. Accurate record keeping is essential for successful tax management. Maintain organized records of your income, expenses, deductions, and credits. Before making major financial decisions, consider the potential tax implications. Staying informed about updates and changes to tax laws is crucial for ensuring you're taking advantage of all available deductions, credits, and tax-saving opportunities. And there you have it, the 6 pillars of personal finance. These pillars are the foundation upon which you can build a secure and prosperous financial future. They encompass everything from budgeting and saving to investing and planning for retirement. By mastering these areas, you can take control of your financial destiny. Remember, personal finance is a marathon, not a sprint. It requires patience, persistence, and a long-term perspective. Just like training for a marathon, you need to pace yourself and stay committed to your goals, even when the going gets tough. It's about making small, consistent changes over time that add up to big results. Think of it as planting seeds that will grow into a bountiful harvest. Each small step you take, whether it's saving a little more each month or cutting back on unnecessary expenses, brings you closer to financial freedom. Be sure to subscribe so you don't miss out. We'll be sharing more tips, strategies, and insights to help you on your financial journey. Stay informed and stay motivated by joining our community of like-minded individuals who are all striving for financial success. Now let's talk about some common financial traps that can derail your financial journey and how to dodge them like a pro. These pitfalls can sneak up on you and cause significant setbacks if you're not careful. Overspending. It's easy to swipe your card without thinking, but those $5 coffees add up. Before you know it, small daily expenses can balloon into a significant drain on your finances. Solution. Track your spending with a budgeting app like Mint or YNAB, and stick to your budget like glue. These tools can help you see where your money is going and make adjustments to stay on track. Not saving living paycheck to paycheck leaves you vulnerable to financial emergencies. Without a safety net, unexpected expenses can throw your entire budget into chaos. Solution. Treat savings like a bill. Pay yourself first. Set up automatic transfers to your savings account each month. This way you ensure that you're consistently building your savings without having to think about it. Bad investments. Get-rich-quick schemes are tempting but often end in disaster. It's crucial to be wary of offers that seem too good to be true. Solution: stick to diversified, long-term investments like low-cost index funds and do your research before investing in anything. Diversification helps spread risk and can lead to more stable returns over time. Remember, personal finance is important at every stage of life. Whether you're just starting out in your career, raising a family, or planning for retirement, sound financial principles remain the same. Wherever you are, these principles apply. Embrace them, and you'll be well on your way to achieving your financial goals and securing a brighter future for yourself and your loved ones.